Hello, welcome to the, Wednesday night live stream. This is going to be a shorter one, only about 10 minutes or so. So hey, if you got any questions, the Q&A video, go ahead and throw them down here in the comment section. I'll answer whatever you got, whether that be questions about personal finance, stocks, investing, cryptocurrency, NFTs, this background that people always think is green screen, but it's not. The snow's finally gone. Could talk about that. Hey, spring in Minnesota. Let's go. Hey, Pepe Aguilar, 99. Thank you for being the first comment. Hi, right back at you. Come on, I know. Hey, Shelby Walt, I know you got some questions. Hey, Germinator, I know you got some questions in here. Stunner 9177. You got some questions, I know it. Well, in the meantime, I posted 2 new videos today. One literally just went up, so I highly doubt anyone's seen it so far. So hey, go ahead and check that out. Tell everyone that, or tell everyone in the comments that, hey, I just came for the live stream. You guys are the best live streams of all time. And I'm gonna go right back to the live stream after I like and share and comment on this video. Germinator, what's happening with NIO? Actually, I have no idea. Let me check out the chart here. NIO. Oh, it looks like it's still going up. Oh, it's been down the past couple months here or so. Yeah, I mean, for those of you who don't know, NIO is an electronic car manufacturer based out of China, I believe. And hey, that's the reason they're going down is probably business-specific risks. Like, hey, maybe they're not hitting their targets, whether that be revenue-wise, production-wise, technology-wise. And that's why I like investing into ETFs, index ETFs, that invest in basically every single stock in the market, like VTI, ITOT, SCHB, because you don't need to worry about one company doing bad. As long as most of the other companies do well, your portfolio is going to do well. Allison Harper joined. BHA04 joined. Hey, who's going to win March Madness? Okay, here is another question. Stunner 9177. Can you claim losses on a stock if it's sold in an IRA? No, you cannot. But the good part about that is you also aren't required to pay taxes on gains within an IRA. So for those of you who don't know, IRAs are individual retirement accounts. And most of the time, you can't withdraw earnings, especially until you're like age 59 and a half. So what a lot of people like to do is invest in, if you do like to actively trade, I would say do it within an IRA. Because let's say you bought a couple shares of Apple in an IRA. Apple went up by $50. You sold those shares. You don't have to pay any taxes on that until, if you're in a traditional IRA, you don't pay those taxes until you actually retire and pull that money out. But if it's in a Roth IRA, you literally never pay taxes on the stock sale unless you withdraw cash early. That's not your basis, so not the money that you put into there. So no, you can't claim losses on a stock if it's sold in an IRA, but the plus side of that is you don't pay any gains taxes if you sell stock within an IRA. You don't pay taxes on any dividends or interest, anything else, any other income accrued within an IRA as long as you don't pull it out. My mom's here, hey! Oh, I know we got some more questions in here. Oh. Okay, I am Sean Patel sucks. Oh man, I don't know who Sean Patel is, but I'm sure he's a great guy. I'm a 15-year-old. I'm planning on investing in ETFs. Is that good? Yeah, that's awesome. Just so you're aware though, you can't actually open your own brokerage account or IRA right now until you're 18. You have to have your parents sign on as a custodian and open like what's called a custodial Roth IRA or a custodial brokerage account. And then essentially it just adds their name onto the account along with yours, and you can do whatever you want with it. But yeah, that's a fantastic idea. I mean, I wish I started investing in ETFs when I was 15. I think I waited until I was probably like 20 before I started making some decent money over the summers in between college semesters. Yeah, the earlier you start, the better. ETFs are what I'd recommend basically everyone invest in as long as you don't need that money in the short term. Because it will, as long as you just keep investing now, it'll keep growing over the long term. And when you turn college age, you're like, hey, I got enough money to pay for like a couple semesters here. Like, hey, this is pretty good. You'll be really happy you did. The Scholar 00. Do people only buy aided funds? I'm not entirely sure what you're talking about, so if you'd elaborate, I would love to hear it. Germinator says, yes, makes sense. Awesome. Okay, let me see what other questions y'all got. Ivan R72 says, just turned 18 and just got Robinhood. What should I do? Well, first of all, switch away from Robinhood. Go sign up for Public, link in my bio. No, I mean, if you like Robinhood, that's fine. The grievances I have against Robinhood is that it makes it far too easy to basically gamify investing. It makes it like kind of more like gambling than you really want it to, especially with newer investors, because it's easy to get caught up in like the day trading back and forth, options trading, all that stuff. Because whenever you buy a stock, whenever you sell a stock, there's like confetti that pops out, and it reinforces bad behavior. Because ideally, you would buy a fund and then not sell it for 5 or 10 plus years. And what I would do is that, well, take check of your cash. Like, okay, how much cash is investable? How much cash do I not need to touch for the next 5 plus years? Like, I don't need to use this towards college tuition. I don't need to use this for a car payment. Don't need to use this for an emergency fund. And then take all that cash and be like, hey, I'm going to invest this for the long term. I'm not going to touch it for 5, 10 plus years. I'm going to invest this into ETFs like BTI, VOO, ITOT, IVV. These are basically just broad market ETFs, index ETFs that invest in the entire U.S. stock market. Well, some are S&P 500, so the largest 500 companies, and some are total U.S. stock market, which is literally all 3,000 plus companies that are publicly traded in the United States. So you can't get much more diversified than that. And I have posted a video a couple days ago explaining this a little bit further with VTI. So if you want a little more explanation on that, go ahead and check that out. But yeah, I'd recommend basically anyone who has cash that's investable for the long term, put this into index ETFs, because one, the numerous studies, one conducted by 2 Nobel Prize winning economists, Eugene Fama, Kenneth French, showed that 80% of people who just invested in index ETFs like this beat every other investor. So like all these other stock pickers, everyone else out there, including professional and amateurs, any given year. And if you do this year over year, you're going to beat basically every single other investor who wasn't invested in index funds over the long term. So the real question is, why do people waste time picking individual stocks when they could just be investing in an asset that's almost guaranteed to get them the highest return possible over the long term in an index ETF? So once again, I like VTI, ITOT, those are the total U.S. stock market ones. And then VOO, IVV, S&P 500. Can't say it enough. The Scholar 00 says, I am 14 and put $1,000 into VOO and made $70 so far. That's awesome. Started 2 weeks ago. Yeah, I mean, it's awesome that you're starting investing at 14. I wish I did. That's amazing. Yeah, I mean, I just say keep investing, keep putting it in. I mean, the market has honestly been a little bit down the past 2 weeks, but here's the thing. You're 14. You have like 4 plus years before you'd even start college. And I've only been investing for 5 or 6 years personally. So, I mean, just the compound interest that's going to be put into effect on this amount that you're invested right now is going to grow that exponentially. I mean, you're probably going to see this double in 7-ish years, 7 plus years, rule of 72. If you divide 72 by the average interest rate, so VOO is around 10%, a little bit over 10%, it's probably going to double in 7-ish years, and it'll double a lot sooner if you keep investing money into there. So yeah, I'd say just keep investing money into VOO. Don't sell it. If you have a big gain, I mean, in 1 or 2 years, you're probably going to see a big gain in there. You're like, hey, like, I'm up a couple $100. Should I sell this right now? The answer is no. Just keep it. Hold on to it. And ideally, you're still going to be holding the same VOO when you're my age, when you're 25. And you'll be like, wow, I'm really, really happy I started investing when I was 14, because that's some of money right now. Fernando J. Sama asks, what is happening this Friday? Quadruple witching. Not entirely sure what you're meaning. I also have been living under a rock the past couple weeks because it is tax season, and part of my job as a financial tax advisor is to prepare tax returns, and that takes a long time. So I haven't really been able to catch up with the news if Jay Powell is doing anything. Okay, the Scholar is clarifying. People only buy index funds over ETFs since they have automatic investing, but ETFs has higher percent. So the difference between index funds and ETFs, they're essentially the same thing, and they're so similar that the words are usually used interchangeably to describe each other, is that index funds are, they're only tradable once per day. So you can only, if you put in a buy order at like noon for $100, that wouldn't fill until the evening, and you wouldn't see it in your account until the next day. But for ETFs, they buy and sell, they trade just like stocks. So if you bought $100 worth of like VTI today at noon, it would probably show up in your account a couple minutes later. Or at least the trade would say that it went through a couple minutes later. yeah, they have very similar expense ratios, basically identical holdings as long as they're tracking the same index, and there's not a lot of downside to either of them. I know, like you said, index funds, one of the big upsides of them is if you like automatic investing. Usually you can only turn on automatic investing with index funds and then mutual funds. We don't like mutual funds. Fees are way too high. So yeah, if you wanted to set up automatic investing for something like your IRA, your retirement accounts, then that's be a great thing to do because it's just automatic money that's pulled out of your checking account, put and invested into this index fund. But if you like going in there and investing yourself, would like a little bit more liquidity so you can buy and sell a lot easier. So if you need the cash, it's really easy to pull it out. It's better to go with ETFs, and yeah, you really can't go wrong either way. Okay, going to do a couple more here, but then it is time to leave. Is Marcus better than Axos Bank? I believe so he's talking about high yield savings accounts here, I'm pretty sure. So high yield savings account wise, I'm pretty sure they're both about the same thing. I'm pretty sure they're both at like 0.5%. Most high yield savings accounts are, so it's really hard to find a one that's better than that. And I think, other than that, define better. I think most of the time, if both the interest rates are the same, which they probably are, just basically take a look at both of their user interfaces, their like UIs, and see which one you prefer. And basically, go with whatever one you prefer. Fully MC450 says, what are dividends? Yes, so dividends are, think of it like you get paid for holding a stock, basically 4 times a year. They're paid out on a quarterly basis. With companies issue dividends to make holding their stock more attractive, and instead of basically they generate earnings, obviously companies make money, and instead of putting this money back into like R&D or putting it somewhere else in their business to help make them more money, they pay some of this money out to investors just for holding their stock. And usually it's like 2% or so of the stock value, so it's nothing crazy, but it can be pretty substantial, especially when you have a good amount invested. And basically, yeah, dividends they're taxed at either long-term capital gains rates, so like usually 15%, could be 0% if you don't make over 40K, or ordinary income tax rates if they are ordinary dividends. Yeah, I have a couple videos on this if you want to get them explained further. Arby's sandwiches 89. I inherited $1 million in an IRA. I have to spend that money in 10 years. That's what my brokerage told me. Well, first of all, sorry for your loss, whoever passed it down to you, but that's a pretty good situation to be in, just monetarily wise. And what that means is that when so it's been a while since I studied this for my CFP. It's been a while since I've dealt with this personally and studied for it. But from what I can recall, you are required to basically deplete the IRA of its assets within that 10 years. And that's because basically the government needs to pull taxes out on this money, because I'm guessing it's a traditional IRA. So when the original IRA holder, whoever the relative was that passed away, when they contributed this money, they got a tax deduction for it. And when they turned age 72 and a half, if they did make it that far, then they were required to take out required minimum distributions. And they basically required to do this for the rest of their life. So the IRA, that's because the government wants their money. So if they pass away and then someone inherits this IRA, the government still wants their money. So basically, you don't have to spend the money, but what I'd say is that, it's $1 million. This is the chance to set yourself up financially for the lifetime. So I'd say, hey, go get a financial advisor, because it's definitely worth talking this through with somebody, and get this invested in a brokerage account and your own IRAs and putting down payment down for a house. Use this to set yourself up for a lifetime of financial freedom, because that's really what this money can do. But make sure you realize that a lot of this will be taxed. If you pull it all out in 1 year, close to half of it's going to be taxed. So I'd recommend, do it in small increments over 10 years just to make sure the tax effect is as low as possible. And then, hey, open a brokerage account, start investing in ETFs or cash that you don't need for a long time, and really take stock of your financial life and just realize how large of an opportunity this is to make sure you never have to worry about money again. And I'd be happy to help with this if you need someone. I'm a professional financial advisor. I'll be happy to help with that. Stunner9177 says KTKS. Okay, a couple more questions. Okay, y'all asked a lot of questions. Good. I'm trying to scroll back up here to make sure I don't miss anyone. Yes, Sean Patel sucks. I love this question. Are short-term chart patterns just voodoo signs / gambling? The answer to that is yes. Is what it's called when you try to read charts, and literally every single piece of academic research I learned as someone getting a finance degree, as someone who was studying for got their CFP, as someone who has been working as a financial advisor for 3.5 years, says that technical analysis is literally, like you said, just voodoo signs / complete BS. It doesn't mean anything. If you read any investment disclosure, it says past performance is not indicative of future results, and that applies to basically everything in the investing world. You can't read patterns on a chart and think that you have a leg up on anyone else that's trading just because you can see 3 candlesticks are in a reverse unicorn pattern and you think the stock is about to rebound off of its low. No, it's not how it works. You win in the market by investing into broad-based index ETFs and just holding them for the long term. People try to overcomplicate it. People try to get rich quick, and it just never works. JYM Cell says, if in my 401k I have the Roth option, should I put my contributions there versus pre-tax? So, most of the time I'd say yes. Just ensure that if your employer offers a match, that they offer it for the Roth option as well, because you never want to turn down free money. And if you are so generally the rule of thumb is that if you're in a lower tax bracket today, so if you're making behind or below 100K, I'd say, then yeah, it's probably a good idea to put it into a Roth, because think about it. Tax rates today are probably lower just in general than they will be when you're 60, when you're 70, because, historically, tax rates have never gone down over the long term. They usually look like this. They usually keep going up. And in 40 years, I'd be willing to bet that tax rates are going to go up. And even then, if they don't, you're probably going to be making more money. If you play your cards right when you're retired, or at least when you're close to retirement, when you can start withdrawing these funds, than you are today, because you watch Nick Talks Money, you know how to smartly invest your money, or no, you're probably going to have a lot of passive income coming in from dividends, from maybe real estate investments, from other things that you're doing. Maybe you got a big CEO gig or something, you're making a ton of money, and it's nice to have a nice Roth option, because for those of you who don't know, if you have a Roth retirement option, whether that's a 401k or an IRA, these funds are not taxed when you withdraw them. Your earnings are not taxed in retirement, which can be fantastic if you let them compound for 30, 40 plus years. Stimmy season, says Thomas Harito. It is indeed. ETFs don't move a lot, says SB0. Yeah, look at the short-term charts, and they might not, but look at the long-term. They gain an average of over 10% per year, and that's pretty darn good if you can keep that up over the long term. When's a good time to get into these index funds? That's K Nas. 1, the saying goes, the best time to get in was yesterday, the second best time is today. So yeah, I just say, don't worry about what the market's doing today. Just get into them whenever you're able to, and just dollar cost average, because you're not investing in index funds for short-term gains, you're investing in them for long-term gains. And in the long term, just any fluctuations in the market will look like nothing. Look at a long-term stock chart of any kind. You'll see a little moves, and it's going to keep going up steadily. And you might see a lot of red when you're going to invest, and it's hey, that's one of those little dips that doesn't mean anything, and everything's on sale right now, so I might as well invest now, because I'm not going to be looking at this until 10 plus years from now when it's going to go up. Unless something terrible happens, and then people are going to worry about what's happening in the stock market anyways, because the apocalypse will be happening. Brandon Ponce 213 says, is Capital One 360 good for teens? I'm not entirely sure. Let's see what 360 is. My first credit card was a Capital One secured card, or not a secured. I think it might have been a secured card actually. So it's a checking account, performance savings. Yeah, I just say, most checking accounts are going to be the same. They're not going to really pay you any interest at all. Capital One, big company, reliable, obviously offer a lot of services, offer a lot of credit cards through them. Just make sure you check to make sure there's not a lot of account fees associated with them. That's the one thing I'd be scared of. But yeah, I'd say I wouldn't have any reason not to trust Capital One. You might want to check some local credit unions, though. They usually offer much better rates than bigger banks do. And both on checking accounts, savings accounts, and mortgages, which you're probably going to need eventually. SB0 says, what's the difference between ETFs and individual stocks? I think individual are going to give you more growth. Yes. So the argument here is that, yes, individual stocks, it's high risk, high reward, especially in the short term. But over the long term, if you were here earlier in the live stream, you've heard me say that index fund investors beat 80+% of all stock pickers, whether they're professional or amateur, any given year. So just think about it like that. You only have a 20% chance if you invest in individual stocks to outperform people who invest in index funds. And that's just for 1 year. So year over year, that 80% chance of winning every year really adds up, and it really beats all those people because most people can't beat index funds year over year. So in like 5-10 years, you're going to be doing better than 99+% of the stock market if you just invest in index funds. So yes, in theory, like individual stocks, if you have a huge exposure to something like Tesla back in like 2010, and yeah, it just completely goes to the moon, then yeah, you're going to do pretty well. But what are the chances of you investing that heavily into a company that has that much chance for appreciation? I mean, I'd rather just go with basically the winning bet, which is going with index funds. Jack Lindsay 3, love this question. Where should I start investing? Is there an app or website that I should use? Yes. So I just partnered with Public, a fantastic investing platform. You can sign up with them through the link in my bio. It's the very first column. They're an investing app that promotes smart, long-term investing. And they allow you to invest with basically any amount of money as long as you have at least $1, because they offer fractional share trading by default. And what I really like about them is if you like Twitter, you're going to love Public, because basically the home screen offers a feed, curated feed, so there's not a lot of BS on there, but it's basically smart investors telling people to invest smartly for the long term. They don't allow day trading. They don't allow options trading. None of that BS. So I'd say, yeah, go ahead and sign up to the link in my bio. You can go ahead and follow me too at Nick Talks Money. Okay, I'm going to answer a couple more, then it's time to get going here. Bobby Darling 0, can you comment on the ideal asset allocation market versus real estate versus alternatives like private equity? Yeah, so I mean, you're not going to like this answer, but it's basically, obviously the ideal asset allocation is going to be different for everybody. One thing I can say with certainty, though, is that if you're a younger person, so I mean, if you're below 30 especially, you really shouldn't be invested in any form of fixed income unless you're obviously like saving for some large purchase like a house. Then I'd say, yeah, put something in a high yield savings account or money market funds. But I wouldn't say like, hey, don't invest in bonds if you're young. Really, there's 0.2 because you have a very, very long investment time horizon, and basically 99 times out of 100, you're going to be way better off just investing with equities for the long term. So as for market versus real estate, I'd say there are people that have. So I'd say market is better for long-term appreciation, probably. I mean, ideally. And then real estate is better for building cash flow, because, I mean, you could charge for rental real estate, you charge rent for people. Or you can invest in places like Fundrise, link in my bio, also just partner with them, love the company. And you get paid a lot higher dividend rates through real estate than you do with stocks. So I'd say, hey, how much do you prioritize long-term growth, which is usually tax-free, versus passive income, which is taxed? But also, real estate does, as a lot of people know, tend to appreciate and usually keeps up with inflation. So it is a nice inflation hedge, and there's not really an ideal allocation between the two. It really depends on your risk tolerance and whether you'd want to invest in physical real estate or not, whether you want to go through somewhere like Fundrise and invest in real estate crowdfunding. And yeah, it really depends on your investment strategies. But for alternatives like private equity, just from personal experience working with multimillionaires who have explored these opportunities, and I've gotten to see the tax statements basically of all these private equity placements, none of them really that we've come across look like great investments so far. I mean, obviously they could pan out, but my boss who has been acting as a financial advisor for 35 plus years, he's consistently says he's never come across a private placement, so like private equity, hedge fund, etc., that has really been better for the client than investing in the market in general. And usually they cost a lot more and they don't deliver outsized returns. So I'd say really stay away from private placements, private equity, hedge funds, if you can. I mean, obviously you can, unless you really know what you're doing, unless you really believe in something and you aren't gonna risk too much of your capital with them, because one huge downside of that is they're usually very illiquid. So if you put a lot of money into a private equity fund, into a hedge fund, then you usually can't withdraw that money whenever you want. You usually have to wait on a quarterly basis. You could probably pull it out, and you usually have to give them a pretty big heads up before you do that. Alyssa Sandomir, do you have any YouTube videos that teach people about investing? So, not yet, but I do have a YouTube account that you can follow. It's linked in my bio underneath the like the Instagram logo. If you click on that, you can go follow me on Instagram and on YouTube. And yeah, I'm thinking probably after tax season's done, so I actually have some time. So after April 15th, ideally, although it is probably going to get extended till May 17th. After then, I'm gonna start making a lot more YouTube videos. I just wanted to focus on building my audience on here first, really put all my eggs in one basket here, or put all my effort towards building an audience here, and it's been working so far. So yeah, I want to build a little bit more of an audience on here, and then try to migrate some of that over to YouTube, just so I'm not starting with really nothing on YouTube. And I know a lot of people have subscribed already on YouTube, and that's awesome. But yeah, go ahead and subscribe on there, and you'll start seeing my videos when they start popping up. If you have anything you want me to cover, I'd love suggestions. Which index funds? That's Austin Crow 93. I love U.S. total stock market index funds like VTI, ITOT, and then S&P 500 index funds like VOO, IVV. You really can't go wrong with either of them. They're all very, very, very low fee and really broad based. Oh, Ross Grease, good question here. I have a good amount of money saved up. Should I pay off student loans in full or wait till I graduate? This really depends on what the interest rate is on your loans. If they're just federal student loans with interest rates between like 3, 4, maybe even 5%, I'd say think about this from a time value of money perspective. You could either let's say you have $10,000. Let's say you put this $10,000 into the stock market, into an ETF like VTI, ITOT, one of those. You could probably earn, on average, over the long term, like 10% plus per year. But if your student loans, if paying them off early is only going to save you 3, 4, 5%, which one's the better option? I'd say what I'm doing personally, since I only have federal loans that are at low interest rates and that are on hold right now because of the whole COVID relief package, I'd invest my money into the stock market, into VTI, into ITOT, into very, very safe index investments, and just hold that for the long term, make minimum payments on the loans, because you're going to end up with a lot more money that way than you would if you just put all your money towards paying off student loans. And it gives you a lot more flexibility because you have a built-in emergency fund if anything pops up that you need money for. But if you have private student loans, if you have something with a like 7, 8% plus interest rates, if you could invest in something that would be guaranteed to get you a 7, 8% plus interest rate, I would definitely do that 10 times out of 10. So anything that high, that has the chance to really turn into a debt snowball. And yeah, I'd say pay that off early. But if they're federal loans, I'd say not. Okie dokie. You're gonna see if there's any quick questions. Okay, I think we are going to be done for tonight. Okay, one more. This is a quick one. Oh, I'm getting public now, says Bracken the Dragon. Hey, appreciate you. Anyone else wants to download public, go ahead and do it through the link in my bio. You get a free $20 slice of stock. It's awesome. I think they actually might have raised it to $100 right now. So, I mean, hey, if you want a free $100, go on and sign up through my bio. And here's the question I was going to ask or answer. This is the final one. What are the best ETFs to invest in aside from VOO? So for those of you who don't know, VOO is an S&P 500 index fund. Great, low fee, broad based. Love it. Highly invested into it myself. But for I'd say there's one class of index ETFs that's even more diversified, that's even more broad based, that invests in more companies, and it's still as low of a fee. And that is VTI, a total U.S. stock market ETF. Which there's also alternatives out there. If you can't find VTI or for whatever reason you don't like Vanguard, you can invest through ITOT and SCHB. They're all basically the exact same funds. They invest in basically every single company in the United States. It's market cap weighted, so the bigger the company is, the more they're invested into it. So you're not like invested the same amount into Apple as you are in like the pizza shop down the road. And the pizza shop wouldn't even be publicly traded, but that's just a small company example. But yeah, that's what I've been investing in my future cash into. well, I started off with VOO, and then I was like, hey, why am I not just investing into VTI? So I've been doing that for the past year or so, and I'd say, yeah, it's fantastic. I don't say there's any reason to sell your VTO, but if you wanted to start investing into something a little bit more diversified that tracks a little bit more of the market, so you're even more safe, essentially, in the long term, yeah, I'd say go with VTI or ITOT, SCHB. They're all the same thing. Total U.S. stock market indexes. And that is all we are going to do for tonight. Oh boy, got a dry throat. I need to drink some water. But yeah, that's all we're going to do for tonight. So I appreciate you guys all for watching. If you haven't seen my 2 new videos posted today, go ahead and check them both out. If you haven't checked out my link in my bio, go ahead and do that. You can sign up for Public, which is I think is the best place for beginners to start investing. Get a free either $20 or $100 size stock. I think the $100 promo is going on, like I mentioned earlier. You could invest in crowdfunded real estate through Fundrise, link in my bio also. Or if you want some more premium content from me, you want my opinion on your portfolio, you can go ahead and check out the other options in my bio. And thank you guys all for watching. Go over to the videos. I just posted a comment that you're watching on the live stream. Make sure you give it a like. Make sure you give it a share. Share it with your friends. Tag your friends. Spam that copy link button a little bit. And I appreciate you guys all for watching. I hope you have a great night.